Hello and welcome. My name is Adrena. I am the owner and accountant here at Accounting by Adrena. And in today's video, we're going to be talking all about Bookkeeping 101. I haven't done like an introductory type video like this before, and I thought I would come back to the basics, especially around the beginning of a new year, because let's face it, a lot of us start our businesses at the beginning of a year. And that's exactly what I did. That was the thought that I had in my mind. I would start on January 1, and that's what I did. So it'll actually be about 5 years that I've been in business. Okay, so anyway, let's just jump right into the video because I have a lot to say, and I really want to talk in terms of theory. And so this is going to be like a little bit heavy in terms of like terminology use. And so I just want to preface that and make sure that you have your notepad and pen handy so you can take some notes from this video, since it will be kind of terminology heavy. So the first concept that I want to introduce is the concept of double entry accounting. Now, this may sound a little interesting and a little funny, but stick with me here because I'm going to do my best to explain it, and I have some notes that I'm going to be following, so hang with me as I go through my notes. So the fundamental accounting principle where every transaction has equal and opposite effects on at least two accounts. So these would be the debits and credits. So for your understanding of how debits and credits work in the context of double entry accounting is to ensure that the accounting equation assets equals liabilities plus equity remains balanced. So I just threw a lot at you, and let me try and explain it this way. So when it comes to your business and you spending money on your business, let's just talk in the terms of like expenses, because I think that's probably going to be the easiest way for us to understand. So let's just say for your business, you need to purchase something. So let's say you're purchasing your email subscription for Google Suite, because I feel like that's going to be the easiest example here. Okay, so when you start your business, you're like super gung-ho about starting your business, and you're like, okay, now I want to get my email. And in order to get your email, you have to sign up with Google Suite, and you decide to have a web address connected to that. And so you want to do a unique email address. So that purchase of your Google Suite account, let's say it's $10 a month, you're going to put that on your credit card. So when you put that on your credit card, it's going to automatically show as an expense to you. So this is going to be a debit on the software and subscriptions category. But the credit, the offset, the double entry part of it is going to be on your credit card or your debit card or your bank account, wherever the money is going to come from. So let's just talk about your checking account. So let's say it comes directly out of your checking account. So the credit is from your checking account. That's actually the cash. And so that cash is going to be listed on your balance sheet of a negative, $10. So it's coming out of your checking account, but it's going to be debiting your software and subscriptions line item. And I talk a lot about entering transactions into QuickBooks. And so think of it like that. So when you have your bank feed set up with QuickBooks, you'll automatically see all of the expenses coming through. But what you're not seeing on the other side is that double entry accounting, where it's actually saying, yes, we're gonna hit the software and subscriptions for this Google Suite account, but the offset to that, the actual cash to that, is coming from your checking account. And so we're going to automatically apply a credit to that checking account. So when it comes to your financial statements, your liabilities and your equity is going to remain balanced, because you'll have the offset of the credit and the offset of the debit, and that would be your total assets. Okay, so we kind of came at it in a like backwards sort of way, but I wanted to make sure that you understood that concept of the double entry accounting, because especially if you're using QuickBooks, you're not actually seeing all of that double entry journal entries like on the back end, because QuickBooks is automatically doing it for you. Now, there are a few rules that I do want to highlight in terms of this concept of double entry accounting. And the first is when it comes to an asset for your business, there is going to be an increase with a debit and a decrease with a credit. For your liabilities, it's going to be an increase with a credit and a decrease with a debit. Now, equity, which is commonly referred to as the owner's equity, this will increase with a credit and decrease with a debit. So just referring back to my notes, the term double entry refers to the fact that every transaction involves recording entries on both the debit and credit side of the accounting ledger. This ensures that the accounting equation is always balanced and that the financial records accurately reflect the financial position of the company. So I hope that was helpful in terms of understanding the actual concept of double entry accounting, because that is crucial for you to understand. And that's why we have a balance sheet, because that balance sheet is going to be balancing all of those liabilities, assets, and equity of your company. And that's what we use in order to verify and validate that your books are in order. And so the offset, the double side to that accounting entry, is going to be showing up on your profit and loss statement, which I know we spend a lot of time on our profit and loss statements in the income, the expense sections. But so it's important for you to understand that connection between both of those reports is really just the whole entirety of your general ledger, which is all of these journal entries referring to the double entry accounting. Now, when it comes to the next concept we're going to be talking about is your chart of accounts. So your chart of accounts is a list of all of the accounts used by your business to classify and record its financial transactions. So this is going to be every single account category that you have set up in your accounting system in order to classify all of the entries for your accounts. So this would be including like all of your income accounts. If you have multiple streams of income, you would want to make sure you set those up separately. This would include all of your expense accounts set up separately, including your payroll and any payroll taxes, including anything related to your home office or your actual office if you have a structure. In fact, I actually just did a video on this for how to set up your chart of accounts in QuickBooks Online. So I'm going to go ahead and link some of those videos down below, but it's the one I just posted last week. So please go back and refer to that when you are setting up your chart of accounts, because one of the cool things that I like about QuickBooks is that it already has kind of like a template for your chart of accounts. So you kind of like, it takes out the like mindless work of trying to figure out, okay, which accounts do I actually need for my profit and loss, for my balance sheet and all that stuff. But there are some really specific things that I mentioned in that video that I want to make sure that you're doing for your own chart of accounts, because really when it comes down to it, it's going to involve making sure that it's understandable to all of your stakeholders. So not just yourself, but also, you know, anybody else that's connected to your business that are going to be looking at your financial reports. All right, the next concept of Bookkeeping 101 is called recording transactions. Now, this is the actual process of documenting financial transactions in your appropriate chart of accounts. So that's basically what we talk about a lot when we're talking about entering your transactions on the bank feed. That's mainly where it's going to be coming from if you're using QuickBooks Online. But if you're not, then you want to make sure that your system is connected to your bank account, to your credit card, and whatever else that you use for your business, and then going through each of those transactions and recording each transaction. So for QuickBooks, we're talking about adding the transactions from the bank feed to your general ledger. So I'm not sure the terminology that other systems might be using, but generally speaking, when you're recording transactions, you are recording them directly to the general ledger. which is going to be the detailed list of all of your transactions according to each chart of account. So I didn't actually write down general ledger, but I'm glad that that came up in that point. Now, the next term that I want to present to you is your financial statements. Now, I've done a lot of talking about balance sheet, profit and loss, and you're probably like, what does it all mean? So your financial statements is an introduction to basic financial statements like the income statement, balance sheet, and cash flow statement. So I've actually done a few videos on this and on how to analyze financial statements, how to read financial statements. And then my favorite reports in QuickBooks Online is basically talking about financial statements as well. So I'm going to go ahead and link all of those videos down below. When you get down to it, it's basically going to be the heart of your business. Now, I like to tell my clients that when we're looking at the financial statements, we want to make sure it's telling the right story of your business. So anytime there is a story to tell, there's always going to be a dollar amount attached to it. So, whether or not it actually hits your accounts. Like, so let's say you did receive something for free. That is something that we want to also make note of. So your financial statements are going to be telling the story of your business. And if it's not portrayed accurately, then it's not going to help you in the long run. And we're going to talk about that in a little bit, but I wanted to make sure that when you are reviewing your financial statements, that you're reviewing it on a consistent basis, because that's really going to be helpful for you in terms of making better business decisions. So more on that in a bit, but let me just finish up the fifth concept here, and it's bank reconciliations. So bank reconciliations really is a matter of making sure that all of the transactions that came through your bank account, your credit card, and whatever other accounts that you have connected to your accounting system, that it matches a one-to-one match with your bank statement. So you download your bank statement at the end of every month, and you compare the download of your bank statement to what you actually recorded into the GL, and those should balance at the end of the day. Now, there could be some fluctuations within your bank reconciliation, and we consider those transit amounts. So for example, let's say that you had a $10,000 invoice sent out to a customer, and that was on December 1st, for example. So you recorded that as an open invoice into your general ledger, but it wasn't paid until, let's say, it was paid January 15th. So there would be an outstanding $10,000 in your bank reconciliation. And so those types of things, you want to make sure that you understand the relationship between your bank reconciliation and your bank statements. So I actually did another video, a tutorial video on bank reconciliations in QuickBooks Online. So I highly recommend you go back and take a look at that. I might actually need to do a updated video because I think this video was done a few years ago, and I just want to make sure that it has the most updated information. QuickBooks always likes to change things and improve their systems. So that is going to be on my list for this coming year. Now, at this point, I wanted to highlight a few things in terms of why bookkeeping is important. And this is just going to go along with the Bookkeeping 101, because I feel at this point you're probably asking, why is this so important? Why do I need to do this? It could be frustrating for you to be doing your bookkeeping, but then that's why I would say to hire out a bookkeeper. But the number one reason I would say why you would want to make sure that you're keeping up with your bookkeeping is for accurate bookkeeping being essential to avoid any tax penalties, interest charges, any other tax issues that may come up along the road. So don't risk overpaying or underpaying your taxes. You can avoid all of that by staying on top of your bookkeeping. Now, the second reason I would say is for legal issues. Keeping your bookkeeping accurate and up to date ensures compliance with regulatory authorities. Don't risk legal action due to inaccurate financial statements. And that is just making sure that, let's just say, all your I's are dotted and your T's are crossed. Now, another important thing to note here is it helps with your business decisions. So, poor bookkeeping can lead to poor business decisions. Ensure your financial statements are accurate to make informed decisions and keep your business on the right track. Definitely a helpful one. And you can also add in like cash flow statements at the end of each month so you can see the fluctuations of your cash flow. And this would definitely help you inform your future spending, which I highly, highly recommend. I think that one actually naturally transitioned to my next point, which was cash flow. So, accurate bookkeeping is crucial for maintaining a healthy cash flow, keeping track of your finances to ensure timely payments to vendors and customers. And, this is something that I do probably maybe a couple times a week, actually looking at my cash flow, because I want to make sure not only that I have enough money to pay my contractors, that I have enough money to pay myself, but also that I have enough money for anything future related. So I always like to keep a nice cushion in my bank account because you just never know. And not only that, but I like to make sure that I'm putting money aside for savings, for taxes, and for all sorts of things. So, I can talk a little bit more about that, but just let me know down below if that is something of interest to you guys. So, that is all that I have for you today. Make sure you're signed up on my newsletter. I'll leave a link down below as well. And I hope you enjoyed this video. Please let me know if you have any questions related to whatever I talked about here in Bookkeeping 101. If you want more videos or something expanded on, also let me know down in the comments below. Thank you so much for watching. Have a wonderful start to your new year. I'll see you guys in the next video.